Hey there again, James Adair from Sierra Pacific Mortgage and the PDXHomeLoan.com team. I made a sequel to my last video, which was written a day or so after the election. Alright, so it's been a week since the election, the big shock, and we're digesting all this news. It's made a big impact on the mortgage bond market. It's made a big impact on the stock market. And I think it will make an impact on our real estate market moving forward, potentially. I think it's pretty likely that, I don't know. Well, let's just get right into it. I'll show you kind of some things that I wanted to show you what happened in the bond market. I think before the election, I heard some economists say that if Donald Trump gets elected, it's going to be, if Donald Trump gets elected, it's going to be a stock market crash, and we're going to lose 10% value across the board of everything. And it sounded just sort of like apocalyptic. And then on election night, I was focused on Twitter pretty intently, as well as television broadcast of election returns. But as it became clear that Trump was going to win, some of the pundits and journalists that I follow on Twitter were sharing about what was happening in Asia's stock market, as well as the Dow futures, and how they were just collapsing. It was down over 800 points, which is is that apocalyptic scenario shaking out. And I went to bed that night thinking, my gosh, when I wake up tomorrow and Trump's going to be president, and the market's going to crash, I think it's going to push a lot of money into bonds, and I think rates are going to be record lows. And I'm going to lock some loans, and I'm going to be a hero. And as I was asleep, it turns out that there was a huge shift in sentiment. His victory speech apparently really settled the markets with its tone of contrition and hope for the future, and I think the market kind of digested that and started saying, well, maybe this will be good for business. Maybe Republican government will lower taxes and spur job growth and be good for business. And we had a huge rally. We had a Trump rally on Wednesday, and for the rest of the week. And you can see here this is the mortgage bond market. A lot of the money. This is the election day. The next day we dropped. The bond market just dumped. And then the day after that, dumped. And then the day after that, dumped again. So kind of scary. And then this is today here. We're kind of leveled off at this new low for the bond market, which actually means rates have gone up. And I'll explain that in a minute. But in order to see really what's going on, I wanted to zoom out. This is a 3-month view, so you can see just how healthy the bond market was. A lot of people buying bonds, and it was very stable. And it started kind of sliding down. This is the run-up to the election, and then we did lose a little bit in late September. Most of October we were very stable. Had a little run up and then run down, but really sideways, and then after the election, just boom. And if we show this path, it's really interesting how these bond charts develop patterns. And this is a downward pattern, and you can see that these three are outside of what we call the channel. And I do think that there is a lot of evidence to support. I think this is oversold. I think there's a lot of evidence that would suggest that this should be higher. And I think we're going to tomorrow jump up back into the channel, which will be good. And then I think we're actually going to test the top of the channel. Because this happened so dramatically, there's a lot of bargains to be had, a lot of value shopping for bond markets. But one of the things that bond traders are thinking of is inflation. Basically, I was saying, yeah, if we can sneak back into this channel, there'll be a potential locking opportunity. So right now, rates are, high, relatively not so bad. We're back into, early 2015, 2014 rate levels. So we that's, this 4-day period is equivalent to a 12-month, normally it takes a long time for the market to shift that dramatically. So we're all just trying to figure out where is it going to end and what's going to happen in the future. And that's what I'm trying to kind of help you guys all figure out here. So bonds tend to want to fill these gaps back in. When there's a big action, there's oftentimes a reaction in the future. But this is such a big paradigm shift. This may take a few weeks to develop. It may not happen till after the holidays. A lot of this is because of the idea that some of Trump's infrastructure policies may prove to be inflationary. And inflation is bad for bonds. It's bad for rates. It makes rates go higher. And I'll explain what's happening. Why is this happening? Fannie Mae sells bonds, and then they fill those bond contracts with mortgages. And bond buyers, when they buy a bond, they're buying a yield from Fannie Mae. Fannie Mae saying, I will pay you 3% for 30 years for X price. And if more people are selling than buying bonds, Fannie Mae has to offer a higher yield to attract more buyers, right? And what happens is, so the bond buyer is buying a yield, and it's filled with a mortgage contract. So the 30-year Fannie Mae yield is directly correlated to the 30-year mortgage rate. So whatever Fannie Mae sells a bond for on a given day, they turn around and offer it to companies like ours and every bank in the United States. Mortgage pricing, they say we need to be this rate when you lock a rate, you're literally locking you're connecting that, you're marrying that mortgage contract to that mortgage bond for 30 years. They're connected for the life of the loan, which is why modifying your mortgage contract is so complex. So that's what's happening. People are selling their bonds and recalibrating their positions in light of this big surprise. So what does that mean moving forward? I don't think, 30-year fixeds are above 4% for the first time all year, or first time since maybe January. And that is, the market's going to have to take some time to digest that and make peace with that. But I don't think 4 to 4.25 is going to dramatically change our real estate market. I do think if we go above 4.5, we will start seeing some slowing. I think that is, we saw that in 2013 when we had a sort of an episode like this over between May and August, where rates went from 3.75 to 4.75, a full point. We saw a big drop-off in activity for about 6 months. So we're going to have to change our expectations. We're going to change some of our activities as real estate professionals to continue to do the kind of business we want to do. But what's good, how does this impact our real estate market? If we have inflation, that means the value of our dollar is lowering. That means things are becoming kind of more expensive. But it also means the more people will have jobs, and it means more people are making more money. That is inflationary. And it's common knowledge that owning real property, owning real estate in an inflationary environment is one of the best things you can do. It's a great thing to own real estate when we're in a rising inflation. So home values go up correlated to inflation, and rents go up correlated to inflation. So it's a good time to talk about investing in rental income properties, because those rents are going to keep going up. The appreciation's still going to happen. People still love Portland, and I think I'm still very bullish that the real estate market will be very strong next year. It won't be like it was. It won't be frenzied, but it'll be very stable and strong. That's my prediction. And I think it'll be really slow between now and January. As we go into the holidays, there's a natural slowdown, and we're all just kind of recalibrating our expectations. So that's going to cause some slowdown for the rest of the year, is what I think. So again, to reiterate, lack of inflation is good for rates. So and today we saw a lot of deflationary news. So the idea that, rates are spiking is all based on what Trump might do. So I think that we're going to see some correction here in the next couple weeks. And then I think we will be heading back, the bond market will ultimately head back to these territories once we know what Trump will actually do, and how that might affect the bond market and our real estate market. But lack of inflation, which showed up today, is good for rates. So we did have some midday improvements, and I think tomorrow we'll see further improvements. Evidence of inflation is bad for rates, but it's potentially good for real estate values, and I think arguably it's good for America. We need some inflation. The whole quantitative easing and the whole strategy of having the Fed buy so much mortgage, so many bonds in the last few years was predicated on the idea that we'll just inflate our way out of it. So we've been hoping for this. Believe it or not, we've been hoping for inflation for a long time, and it's been slow to come, but looks like it's coming here soon. So thank you for your attention. I know I've prattled on here for a long time. Hopefully it helps you understand what's happening, and I'm happy to talk to you about this one-on-one. Give me a call. The phone number's right there on the screen there. So talk to you later. Hang in there.